My name is George Stagnino. I'm the editor of the Peter Deck Portfolio Strategy and Management. I think the charts and the trends I'd like to show you are quite important, if nothing else, because so far they made me say the right things. And I believe they are money-making trends. Let's dig into it. I have been in this business for 40 years, in fact, since the 70s. In fact, in the 70s, I was ranked number one. And the reason I was ranked number one is because, I had pictures from Forbes and ahead of the big names. And the reason was because I realized that in inflationary times, the best performance is short-term money market instrument. So I was for, I don't know, 6, 7 years in treasury bills. Of course, I didn't sell any subscriptions because my subscribers saying, I don't need you if you're telling me to buy treasury bills. But the truth of the matter is that has been the best investment advice in those days. Now, I'm having a group here in Akron of investors and friends that want to talk markets. This is my passion, so I do this 24/7. And we started, I don't know, a year, two plus ago. And the first chart I showed is, my friends, this is the chart of the Dow Jones in the 70s. And for 12 years until 1982, it didn't do a damn thing. And the best investment was Treasury. So I said, well, we are facing right now in 2022, 21, 22 inflationary times. And so the best way to invest is in cash and treasuries. So far, it seems to be the right advice. However, there is some trends that I follow, and I'd like to show you these charts because they're very important. They're sort of not easy to recognize because there are a lot of lead lags, and the lead lags in what's happening in the financial markets are very, very important. So let me go through it, and let's see if you agree with me. Hopefully you do. This chart is very, very important and is totally misunderstood by many investors, by the press, by the experts, and everybody. And the reason is people do not understand the basic relationship between short-term interest rates and stock prices. It's in the business cycle, by the way, which is, I think, my expertise. So what these graphs represent is the stock market. This is the red line. And the blue line is the yield on 2-year treasuries. Now, when people say the interest rates have peaked, interest rates have peaked, interest rates have peaked, and here I think they have peaked, they all get all excited and they say, gee, I want to go and buy things. There's a bottom in the market because the Fed is easing. That's a total nonsense, I think. And let me show you why. When short-term interest rates decline, it's just ahead of a recession, just ahead of a recession, just ahead of a recession, and just ahead of a recession that is coming now in 2023, 24. Now, the reason short-term interest rates decline is because business is so bad, and there is a slowdown, inventory correction, business, new orders, everything is going bad, that the markets are driving short-term interest rates down. But the same forces that are driving short-term rates down are exactly the same forces that are taking earnings down, profitability down. So, and this is why the stock market peak when really short-term interest rates start declining. So the fact that short-term interests are declining actually is a trigger that should make you very, very, very cautious. In fact, it takes, if you think that here these interest rates are peaking, look when the stock market bottomed. It bottomed roughly what, a year and a half after that. Interest rates are peaking. Look when the stock market bottomed, way after the short-term rates have declined. So it takes a long time. With declining interest rates, they decline probably 100, 200, 300 basis points before the stock market peak. So this means that with interest rates now at 4.5%, the market will peak when 200, 400 less 200, when interest rates are back to 2%, if history is any guide. The same thing here, and the same thing will happen here. So if interest rates decline, the last thing you want to do, according to this chart, is to understand this, of course, this is not investment advice, but what the history here shows, that if short-term interest rates decline, you better be very careful, because the worst is yet to happen. So now let's see what the other three charts, basically what the other three charts are confirming what this chart is saying. Okay, let's get a little more technical now. And let's look at the difference between the 2-year and the 10-year treasuries yields. By the way, I strongly believe that anything useful or that I understood about the markets is all given, all the information is given by how interest rates behave. You don't need anything else, as these four charts will clearly tell you. This is the difference between the 2-year and the 10 years. When the difference is negative, means that the 2-year is greater than the 10-year. Like here, like here, like here, and like here, and like here. So what this is saying is, but remember, this is when short-term rates are declining. So the yield curve, the difference increases. The difference increases when short-term interest rates decline. This increases, and this increases. So when the yield curve steepens, the bottom of the stock market, so the fact that the yield curve is steepening, it doesn't mean anything, because it takes, even if this starts here, it takes a year. Even if it starts here, it takes a year and a half. Even if the yield curve starts steepening here, it takes a long time, and so on. So even if the yield curve starts steepening now, the bottom of the stock market is going to be a year and a half from now. I know you'll never subscribe to my service because it's such a long-term forecast. But on the other hand, we monitor these charts, and if nothing else, we just want to make sure we are right. So this is the bottom line. The yield curve has to steepen. In fact, not only cross above zero, but has to come very positive sloped before there is a bottom in the stock market. So what this yield curve is saying, that is the bottom of the stock market, it will take maybe, say, a year to be safe. Let's see the next chart. This is a very important chart. It's a very important chart because it's saying one basic thing. I've never seen anything like it. And no one knows what the implications are. We don't know, but it's something very, very unusual. I discussed that, by the way, in early March in one of my videos, which I called The Coming Financial Crisis. And sure enough, after 2 weeks, we had the problems with the banking system. This is again, is difficult to understand because we don't know. No, what we know is something bad is happening, because it's happened only during maybe the Great Depression and another time. Let's see what I'm talking about. This chart shows two basic lines. The deposits in banks, commercial banks, and the blue line is the growth in the money supply. What I'm focusing on is on both, because here they're both declining. The change is negative. Now, the reason I look at deposits with commercial banks, because this data are released weekly. Instead, the money supply is monthly and it's late. It's all bureaucratic stuff. But anyway, so the deposit in commercial banks are contracting, and the money supply follows very closely the deposit with the commercial banks. Now, why is that important? Think about it. The banks are the only organizations that are allowed to print money. They print money. How do they print money? Out of deposit. You put $100 in the bank, they lend $80. So there is this, you put your money in another bank, and so they relended 80%, and so on and so on. So that's how the money supply grows. The fact that the bank deposits are declining, there are two things. Either people are putting some money somewhere under the mattress, or banks are not lending money. And the contraction in the deposit means that banks are really worried. They don't lend money. They see something that we do not see. And again, when I said this at the beginning of March, and I didn't know about this financial crisis stuff with the banks, that's exactly what the banks are seeing. So what I'm talking about is the growth of the money supply, or if you want to be more timely, the decline in the growth of the contraction in demand deposit at commercial banks is something very, very worrisome, because here they went up sharply and now here they're coming down quite sharply. So this is the kind of things you have never seen in history, never seen it in history. And that's why you have to be even more careful, at least according to my way of looking at things. So this thing is not over. What we are going through is not over. There is something very wrong that we are going to face. How do you do? What kind of things? Investment. Well, I have other videos on this and that I will discuss, but I'm not finished yet. There is one more chart, and then you know everything I know. So why are banks not lending? Because they're scared. And this is why. This is the other piece of information that tells you why they're scared. This is the percentage of banks tightening lending standards. And the overwhelming majority of banks, the net percentage is around 50% right now. And when banks at more than 50% are tightening lending standards, there is a problem. And the problem, what you see is this gray line here, gray line and gray line. There's a recession. And usually recession are accompanied by a big decline in the stock market. So here we are here with bank deposits declining because banks are not lending, money supply is contracting, and banks are not raising lending standards. So the climate that we see ahead is not rosy at all. Not rosy at all. So if you see in the rain, as it happens now, forget about the Fed. The markets are already lowering interest rates from what, 4.5% on the 2-year treasuries to now 3.8%. So the markets are already taking interest rates down, but they're taking interest rates down because the economy is weak, because business is having problems. That's why commodities, that's why interest rates, that's why inflation, they're all coming down. Things are weak, and they're likely to become even weaker given these 4 charts that I've shown. Of course, I'm going to discuss this more in my service, but anyway, I think you should keep in mind these 4 charts because they're very, very important, and I will update you on this, what's happening in the future. But let me tell you something more, though. Well, in case you're interested in my work, I publish the Peter Dark Portfolio Strategy and Management. I'm not going to go tell you what's in it because it's going to take forever. But you can have a free subscriptions. There is no need for credit cards. You can do anything. Anyway, if you'll never be charged, well, we don't care about your credit card. So just look at it, see what happens. And basically, I deal with this kind of subjects. And then I talk about, there is some timing concern about near term. But it's a macro strategy kind of investment that gives you the big pictures and where possibly you are not going to lose money or where you're going to make money. I wrote this book. It was published, actually they paid me to write it, McGraw-Hill Education, because they saw my website, they saw my study on the financial cycles, the inventory cycle, the business cycle. So they say, why don't you write a book about this subject? I was teaching a course on economics for macroeconomics for management. So I did it. I have the notes. So why not? I just put it in words. I also wrote 2 more books and all my articles on www.peterdac.com. And by the way, if you follow me on Twitter at George Dagnino, I update some of these chats quite often. So we'll keep in touch. You send me a question, I always answer within 24 hours. So I do this because I like what I do, by the way. Well, I appreciated following this video. I hope you find something interesting and useful for you to use in your investment. Okay, I really hope you check it out to become a subscribers and follow me every time I publish one. They will encourage me to give you more and more information. Okay, thank you very much. Have a nice day. See you soon, I hope. Take care.